Thank you very much, and welcome to you all. I'll just say that beside me here is John Flynn, head of our IEA, Irish Economic Analysis Department, and this side we have Gillian Phelan from the Monetary Policy Division who will present. So what we will do, first of all, is have a presentation. The presentation will be structured in a number of ways. First of all, Gillian will present on the international outlook. Then John will present on the forecast for the domestic economy. I will make some observations regarding the policy messages of the bulletin. And then finally, we'll bring you briefly through the 3 signed articles which are contained in this bulletin. So with that, maybe I should pass the floor to Gillian.
Thanks, Gabriel. Thanks, Gabriel. So as usual, I'll just start with a brief introduction in terms of developments in the international economic environment. So the first quarter of 2015 produced some more encouraging data for the euro area, where there was an increase, although it was fairly modest, in GDP growth over the final quarter of 2014. The outlook for growth has also improved, with ECB projections released in March revising up estimates for growth for 2015 and 2016, and they're up to 1.5% and 1.9% respectively. Growth has also remained relatively strong in the US and the UK during the final quarter. In contrast, the IMF's global growth forecast was revised down during the first quarter of this year, and this is largely due to slowing down in emerging market economies such as China and Russia. The IMF's estimates also reflect an expectation that the benefits to global growth from oil price increases are now less certain, and that's partly due to the appreciation of the dollar. Meanwhile, inflation rates continue to fall globally, as direct and indirect effects of the oil price decline weigh on consumer prices. In the euro area, headline inflation reached a joint record low of just 0.6% in the first month of 2015, while core inflation, which excludes food and energy prices, also recorded a historical low just a month later. Finally, turning to monetary policy, the ECB's expanded asset purchase programme, which was announced in January, so purchases have begun this just last month, and the reaction in financial markets has been positive, with sovereign yields in the euro area continuing to reach historical lows and equity indices performing strongly. So to start with looking at growth in the advanced economies. So the euro area finished 2014 more strongly than anticipated, with growth of 0.3% driven by expansion of 0.7% in both Germany and Spain. The return to strong growth in Germany was attributed to domestic demand, in particular household consumption expenditure, and also an increase in investment. Consumer spending increased across the euro area as a whole, supported by falling unemployment and modest income growth. In the US, the final quarter growth of 0.5% was led by strong data for personal consumption and residential investment. The labour market has also continued to improve, with headline unemployment rate falling to 5.5% in February. That's been its lowest level since mid-2008. So due to these economic developments, and with the FOMC no longer using the word patient to describe its normalisation of monetary policy, expectations of the first US dollar rate increase have now increased for the first time in a decade. Finally, the UK finished 2014 with its eighth consecutive quarter of growth, as output rose by 0.5% in the final quarter. The largest contribution to growth came from net trade, while household consumption and expenditure also increased. House prices are a key driver of growth in the UK economy, and they continue to increase at a very considerable rate, with the latest data showing annualised growth of just under 10%. So looking further afield at the IMF's updated projections released in January, they revised down growth expectations for emerging market economies. Growth is now projected to be just 4.3% in 2015 and 4.7% in 2016. So that they've been reduced by 0.7% and 0.5% respectively. The outlook has deteriorated primarily due to conditions in Russia and China, as well as negative impact of energy price decreases on net commodity exporters. In China, final quarter growth in 2014 was almost 0.5% lower than the corresponding quarter in 2013, as reduced domestic investment due to slowed property market combined with weak global demand for exports. Looking forward, required rebalancing in the Chinese economy, followed by slowdown in investment and credit growth, may act as a drag on economic activity. In Russia, economic activity continues to slow, with the latest quarterly GDP release showing growth of just 0.7%, and that's the third consecutive quarter of declining growth. So looking at inflation developments across large economies, there's a clear downward trend in the first quarter of 2015. The euro area, the US and the UK all recorded at least 1 month of headline inflation of 0% or below during that period. In the US, headline inflation was negative in both January and February, and it's expected to fall further before it moves back into positive territory, with projections showing that a trough will be reached in the second quarter of 2015. Meanwhile, the 0% inflation recorded in the UK for February was a record low. Only Japan recorded headline inflation somewhat near the central bank target during the first quarter. However, the rate of 2.4% for January was heavily influenced by an increase in consumption tax. Oil prices, which declined by 60% between last June and mid-January, have played an important role in price developments globally. Since mid-January, prices have stabilised, and the impact of energy prices on inflation will gradually reduce moving forward. Finally, just look briefly at developments in financial markets. As detailed at the release of the last quarterly bulletin in January, the ECB has initiated an expanded asset purchase programme, which includes sovereign bonds and European agency debt. Purchases have since commenced at a rate of €60 billion per month, and they will continue until September 2016. The expectation of increased demand for sovereign securities has placed downward pressure on yields, with yields reaching historical lows across a range of maturities, and the 10-year benchmark spreads against the German Bund have narrowed significantly for peripheral issuers. The programme has already had an effect on other asset prices, which is important for the portfolio rebalancing channel of policy transmission. Equity prices have risen considerably, with a 16.5% rise in the Eurostoxx index between the end of 2014 and mid-March. There has also been positive momentum in equity markets outside of the euro area, with FTSE All-Share Index and the S&P 500 both reaching record levels over the review period. Finally, on currency markets, the euro has weakened against key trading partners, with the nominal effective exchange rate falling by approximately 11% over the first quarter. So I'll pass you back over to John, who will take a look at developments in the domestic economy.
That's great. Thanks, Julian. Sorry. Yeah. So to begin with, the main message from our forecast this time is that the recovery in the Irish economy is continuing to build and to broaden out. While exports were an important driver of growth last year, if we look over the course of last year, the recovery has become more balanced. On the domestic side, strong investment growth, which we've seen for some time now, was supported by the beginnings of a recovery in consumer spending, which has shown signs of gathering strength. The pickup in consumption has benefited from continued growth in employment, and that growth in employment is serving to boost incomes. So with consumer and investment spending growing last year, domestic demand actually grew by almost 3%, and it was the first time that domestic demand contributed to growth since 2007, which was a significant development. On the external side, last year saw exceptionally strong growth in both exports and imports, and to a large extent this reflected the impact of contract manufacturing outside Ireland. Now, contract manufacturing happens when a company in Ireland contracts a company abroad to manufacture products on its behalf or to produce something on its behalf. Now, given the high import content of Irish exports, the growth in offshore manufacturing activity in 2014 significantly boosted imports as well. So what we saw last year was, as well as very strong export growth, we saw very strong import growth too. And this took the form of strong increases in services imports, which were largely related to strong growth in licence and royalty payments. And that was particularly so towards the end of the year, so in the fourth quarter data. In overall terms, if we look at last year, domestic demand and net exports contributed roughly equally to growth last year, so they both drove growth to a similar extent in 2014. Now, looking ahead for 2015 and 2016, our expectation is that growth will come to be driven more by domestic sources going forward. So we think that the net export contribution will ease off slightly, and that domestic demand will become the more important driver of growth. Now, to look at the numbers, the table here shows the latest numbers that we have. And just to start by looking at 2015, our forecast for the economy in 2015 is for the economy to grow by 3.8%, which is marginally higher, but only by 0.1 higher than our previous published forecast. So essentially, we don't see much change, and nor do we see much change in 2016 as well, but I'll talk about that in a minute. Now, while the overall forecast is broadly unchanged, we do see some change in the composition of growth, with domestic demand playing a kind of a slightly stronger role than we projected at the last time when we made our forecast a couple of months ago. And the main reason for this comes from the improved outlook for consumer spending in 2015. Over the second half of last year, we saw sort of a gathering momentum in consumer spending. We saw it picking up. And the higher frequency indicators that we have for the early months of the year suggest that this momentum has been maintained. So with that, and with employment growth picking up, and with that serving to boost incomes, we think that consumption will be a little bit higher than we projected last time we made our forecast. So we've pushed our consumption forecast for this year up to 2.2%, which is 0.3% higher than in our last bulletin. Significantly, I suppose it's double the rate of growth in consumption in 2014, but that wasn't a particularly strong rate of growth if we looked at it in relative terms over time. Now, although slowing slightly from its kind of more recent strong pace, or very strong pace, I suppose we still see investment spending growing pretty strongly in 2015, and that will help kind of the rebound in investment to continue. It will help to bring the investment share of GDP back towards its long-run level, although it still has a little bit to go to get back there. On the external side, the growth in contracted production in 2014 complicates the task of forecasting exports. But looking ahead, we're making our projections on the basis that exports will return to growing in line with demand in trading partner countries, which is traditionally kind of what we would expect. Now, helped by the fact that Ireland has trade links with some strongly growing countries such as the US and the UK, that's still going to continue to generate strong growth, or reasonably strong growth in exports. So we would expect strong export growth to continue. And carrying over a little bit from 2014, though, we would also expect strong import growth to continue. Now, overall in net terms, while exports will still make, or net exports will still make a contribution to growth, in terms of net contribution, it looks like it'll be the domestic side which will be the main driver of growth in 2015. And the latest forecasts that we have for both consumption and investment, if you combine them, suggest that, domestic demand is now going to grow well above 3% this year, which is a pretty decent performance, but it obviously has to be seen as a kind of a rebound from what was a low base. Now, although the recovery has broadened and is gaining momentum, inflation has remained relatively subdued, and obviously softer oil prices have played a big part in that and have had a dampening influence. While oil prices have moved up a little more recently, on the basis of prevailing futures prices, which we put into our forecasts, we still expect headline inflation to remain pretty moderate in 2015. On balance, there may be some upside risk to our forecast kind of from domestic factors because, as I say, consumption has some momentum. Exchange rates may give some impact as well. So there are some possible positives there. Potential downsides, I suppose, could come from external factors depending on how they may play out, but there are maybe some potential upsides. Obviously, on the inflation side, things will be affected by movements in oil prices, so in terms of whatever happens there. If we look at 2016, as I said, the outlook for 2016 is pretty similar to 2015. We have GDP growth forecast at 3.7% for next year, again, marginally changed. very marginally changed from last time, but essentially no real difference. And again, the composition of growth in 2016 we think is much the same as this year, kind of with the domestic side continuing to grow and consumption more or less growing by about the same rate as this year. Investment again remaining strong, and export growth also projected to remain strong. But obviously there's some uncertainty attached to those projections, so as we go kind of further through the year, we should have a better handle on that. Just to say a little bit, I'll finish by saying a little bit about the labour market, because the labour market has been very much, I suppose, the bright spot or the brightening spot of the economy for some time now. The recovery in the labour market has been going on for about 3 years now. And the level of employment is kind of over 5% higher, I suppose, than it was at its lowest point back in 2012. Over the past year, we've seen the unemployment rate fall by almost 2%, and unemployment now stands at just over 10%, but obviously that's still high. If we look at kind of what's happening in a little more detail, kind of the kind of growth in employment has broadened out across the economy and is more or less spread through the private sector at this stage. It's fairly broadly based. Encouragingly, employment growth continues to be driven by growth in full-time employment. So initially when the labour market recovery started, it was more growth in part-time employment than full-time that we're seeing. Increasingly, we're seeing more growth in full-time employment, and obviously that supports earnings growth, which then supports consumption in turn. And encouragingly, we've seen the numbers of long-term unemployed continue to fall. So looking ahead, kind of we would expect the kind of current trends to continue, if you like. The trend is favourable. We've an improved outlook for domestic demand, so we would expect employment growth to kind of average just over 2% this year and next year. Labour force growth we see as being kind of more modest, just over 0.5% this year, just under 0.5% next year. So that should tend to sort of pull the unemployment rate down further, and we'll be forecasting an average rate of 9.8% for 2015 and then 8.7% for next year. But obviously end-year rates in both cases will be lower because we see the trend moving down. So in terms of the outlook then, those will be kind of our main thoughts on kind of what's coming. So I'll pass back to Gabriel now.
Thank you very much, John. So what I've tried to do briefly is just present something of the main messages from a policy perspective of what's in the current bulletin. And if I was to try to summarize it in one sentence, I think the key message we're trying to get across here is the need to build more resilience into the economy. And this has two aspects. There is a fiscal aspect and a financial aspect. Now, on the fiscal side, it's very clear there have been very substantial improvements in the fiscal position when we compare what was the case just a number of years ago. And in addition to the policy measures that have been taken in the past, in more recent times, the fiscal position has benefited a lot from strong economic growth. And you saw that, for example, in the exchequer returns for the first 2 months of the year. However, I mean, this is not the end of the road. There is a need for further consolidation. From an economic point of view, the level of debt, although it has fallen, is still very high by international standards, and it means that the economy would be vulnerable to adverse shocks, should those shocks materialize. There is also, of course, a related issue that the European rules require further consolidation. So whilst we have a deficit of 2.7% of GDP budgeted for this year, that is above the medium-term objective, which is a balanced budget in structural terms. So there is a need for further fiscal consolidation of the order of 0.5 percentage point of GDP in structural terms over the next few years in order to meet that. So it's both sort of like a legal and solid economic reasons that we need to have further fiscal consolidation. In the particular context that we have, of course, we have a very strong growth in the economy, as John has indicated, significant employment growth. So I think that there is not a case for fiscal stimulus to boost the economy. Indeed, that might even exacerbate the conditions in the economy. Now, turning to the financial situation, we clearly have seen over the last 12 months or so very substantial improvements in a number of dimensions. We have seen improvements in the balance sheet of households where debt to income ratio has fallen. We've seen improvements in the situation with regard to mortgage arrears. We have seen a situation where the banks have returned to profitability and where a range of indicators are pointing to some improvement in the availability of finance, availability of credit to the economy. So there have been substantial improvements, but nonetheless, I mean, one of the key lessons we probably have learned from the crisis is we need to make sure that the financial system is resilient, particularly the balance sheets of households and also the balance sheets of the banking system. So it is with that in mind that the bank introduced the new regulations regarding the macroprudential regulations regarding residential mortgage lending. These followed a process of a long process of extensive consultation, and the measures were announced. The detailed measures were announced in January and have come into effect in February. And we're hopeful and confident that these measures will contribute, and there'll be a major contribution on the part of the bank to building the resilience of the financial system. So at that, I think I can turn back to John, who'll take us through the 3 signed articles in the bulletin.
Yeah. So and on this occasion in the bulletin we have 3 signed articles produced by various authors from around the bank. And I'll just say a little bit about each of those, and we have the authors with us today, so if you want to follow up on any of those articles, we have people available to talk to you. The first article looks at the changing nature of Irish exports. It's by Stephen Byrne and Martin O'Brien. And it makes the point that there's been a significant shift, a structural shift in the composition of exports. So if we look at it, there's been a significant rise in the services share of exports. We see, for example, concentration of exports in things like pharma, IT and business services. And as well as that, there's been a growth in import intensity as well. Increasingly, and this has to do with the way multinational enterprises globally tend to operate, there's been a kind of a fragmentation of production, and this fragmentation of production has led to kind of an increasing use of cross-border production processes by multinationals. And given the size and significance of multinational companies here, it's something that has had an impact and has had an impact in changing the nature of our exports. So I suppose what that means is that the channels then through which export growth is determined have changed. So because this cross-border production has an influence. A point that the article brings out strongly is that value added in production can differ very much from the gross value of exports, and that value added as a share of gross output very much depends on the import intensity of production. And that import intensity can reflect either kind of materials, intermediates kind of which are processed here, or then kind of offsets of things like later on, like services imports to do with things like licenses and royalty payments. And so these things all have implications for the ultimate benefit to national income. So it works through kind of how you might look at exports from that point of view. The second article which we have is an article by Mary Cusson from the Statistics Department, and it looks at kind of new insights that can be drawn from enhancements to the quarterly financial accounts. So a number of enhancements to the QFAs, the quarterly financial accounts, have been made, and these enhancements include the publication of what's called from of whom to whom data for deposits and loans, kind of which is published for the first time in this new enhanced data. The whom-to-whom data disaggregates each sector's total deposits and loans by counterpart sector, so you can get a much better picture of kind of the interaction and the flows kind of between the various sectors. Other notable features include a change to the definition of non-financial corporations and also the publication of non-financial corporations' trade liabilities, which is an important source of funding for non-financial corporations. The findings of the article are that if we look at things, say, since 2008, so it's kind of since the crisis period, really, that there have been significant inflows into government deposit accounts by households and outflows from money and financial institutions, and that's shown in the chart there on the right of that slide. It's also shown that the change in definition of the NFCs, the non-financial corporations, markedly reduced Irish NFC debt, but it still remains quite elevated. But there's some changes in the accounting for that. And that nearly half of NFC debt was, if we look at it, was with non-resident lenders, which obviously then reflects the fact that the NFC sector itself kind of incorporates multinationals, and that has an impact as well. So there's quite a lot of kind of new insights in that article as well. So again, I'd encourage you to look at that. And the final article then is from our Financial Markets Division. It's produced by Emer Curtin, Brian Gallagher and Fionnuala Ryan. And it looks, it's a kind of an annual look at the monetary operations and financial development, the monetary operations, of the ECB and the financial market developments over the course of the last year. So the article brings out a number of points. It shows that if you look in the euro area, that the accommodative stance of the ECB tended to support financial markets over the course of 2014. It also makes the point that the sort of fragmentation in money markets across countries that we had seen sort of more in the intense period of the crisis has eased back in 2014 to an extent, and that continued a trend I think that had started in 2013. Kind of reflecting these things, I suppose partly responsible for them as well was the fact that counterparties' recourse to Eurosystem borrowings gradually fell over 2014, and kind of related to that then there was a reduction in excess liquidity kind of for most of the year anyway. So again, that provides a lot of detail and a lot of insight on developments over the past year. So those would be the three articles that we have this time. So
Thank you very much, John.